Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is February 23rd edition of Market Outlook. Very interesting week. We're at a key inflection point. We're going to get into that right away. Don't forget to sign up and get this free video newsletter every week at www.marketgauge.com. First of all, the S&Ps, as you can see, it stalled right at all-time new highs. This is quite interesting. Obviously, if we break down beneath the 50-day moving average, which is that blue line, about 180, 140 or so, that's a critical level. What we are is not stable at these prices. Remember, you've got plenty of power now built in to the consolidation just in the beginning part of the year and early part of last year, plus the last week in February here. So you've got a lot of power building up in this compression zone of the market, which pays to pay attention to. And again, the calendar range will break down and coincide with the 50-day moving average as well. So we definitely want to pay attention to this red line right here and that 50-day moving average as well. Let's take a look at a couple of the other charts. You can see we have a nice channel going back all the way to the mid part of 2012 as well. So we are consolidating at the upper end of this channel. And again, I want to reiterate, on a relative RSI short-term basis, we sort of paused as we hit a relatively high level. Looking quite a bit different in the Qs, however, as we've already taken out the highs and are now pausing here as well. Now, a little bit better volume patterns in NASDAQ. So clearly the action in a smaller universe of stocks, the 100 NASDAQ stocks, acting better, that it's tech-laden, semiconductor-laden, and also biotech-driven, which are the leading sectors at this point. So you can see here that we did have a lot more accumulation days in NASDAQ. So there's definitely a split personality in the market. Gives us a little bit more hope here that things aren't as weak as what it appears to be in the S&P. But definitely bears caution. If we take a look at the DIA, another completely different story, and you can see that the major industrial companies, the 30 industrial companies, are basically at the 50-day moving average and are struggling at that. So you can see as you look at different indices, very, very light volume recently on this last part of the run-up, also making it a bit suspect. Let's take a look at some of the market internals here. You can see on the McClellan oscillator, we got a bit overbought, hooked down. That is a intermediate term sell signal. To us, intermediate term is several weeks looking out or more. Now, what we haven't gotten is a confirmation on the shorter term market internals, the advanced decline and the up-down volume, but they have hooked down, and as I noted to you just a moment before, you can see that the volume here not nearly following the breadth of the advancing versus declining issues. And in fact, another day or two of weakness, and we could start generating a negative reading here, hooking down beneath what we would call overbought indicator. So as we're still sitting at overbought, but above it, that is still positive. We have to watch now intra-week to see if we get a hook down. Again, a sell-off in both the advanced decline and up-down on the 10-day averaging of that would be a real confirmation across the board of a sell signal. Market volatility, the VIX indicator. You can see the 50-day is sitting right here on the 200-day, and we're basically closed on it. So volatility is giving us a cautionary reading. We don't like when we trade at or above the 50 and the 200, and that's what we're doing. So on the big sell-off, we have not corrected. It's interesting. There's definitely a bit more nervousness in the market, considering the fact the S&P is trading at all-time highs or just a fraction below it, but the volatility index is not. It's trading well above the lows that were put in earlier this year. So a bit more fear in the market, even as the market's sitting here. That should take your attention as well. So the evidence is definitely coming in a little bit more that things are a bit questionable here. And so the short-term pattern in the market is going to dictate which way we're going to play. Now, also confirming a bit more nervousness, we have been talking about gold and GDX. Gold has nicely held its 200 monthly, its super long-term moving average, and bounced off it quite nicely. As you know, we've been talking about this since the early part of the year, where it put in that slingshot key reversal bottom. It's moved off nicely, and one of the better performing assets of this year, reversing last year's dismal performance. And also take note that it has done it on really good volume. Also, keep in mind that the gold miners also has moved off its lows as well and has been putting in a really nice bottoming pattern, and the 50 days turning up, and it held nicely all this week, put in a really good a good performance overall. So we've been basically long the silver gold ratio and gold miners as well, and we continue to hold. So what we really want to see on the gold miners is basically holding at around this 200-day moving average as it moves into an accumulation phase. And by the way, we have been doing this move up here in the gold miners on good volume. If it wasn't for Newmont Mining's reporting relatively poor performance, you can always count on Newmont's management to screw things up, that things would have been quite a bit even better for the gold mining index last week. All right, moving on here. Let's take a look at bonds. As you can see, bonds, TLTs, still under pressure. Tried to take out its declining 200-day moving average, failed there. So we're watching again for a potential move above the 200, but things definitely are looking a bit heavy. You can see on the weekly charts our shorter-term weekly moving average accelerating rapidly to the downside. It's almost inevitable that it's going to be attacking its longer-term 200-week moving average as well, which would put the weekly pattern into a death cross. And interestingly enough, the 200-week moving average actually acted as a repellent to the recent highs, almost to the tick as well. So we definitely want to watch that 109.50 level, as that would be an indication that possibly the decline is over in the interest rates, or that the rates continuing to rise might be pausing. But for now, we're still trading under it, and the market is under pressure, so we continue to have a negative bias overall on long-term outlook for rates, meaning we're thinking rates still are poised to rise. Now, let's take a look at silver. Silver exploded to the upside, moving the gold-silver ratio that we've been focused on as well to a nicely positive position. This is an interesting sign when silver outperforms gold handily, and that ratio looks to continue to improve. In addition, silver itself moving more into a positive phase. You can see we got an upturn in the 50-day moving average, which is what we like to see. This is sort of a classic pattern here. Taking a look at the silver chart, you can see that as we started to get a rise here, in the 50-day moving average, you can see we were moving down. Rallies were meant to be faded even as we approached and traded above it. But as we traded above it and the slope of the 50 moved positive, the market moved up nicely and on excellent volume as well on the breakout. So we continue to be positive overall in the metals, potential bottom forming. The fact that silver's outperforming gold is also a positive development. We're looking at a potential move up here to 24 or so, and then we'll take another look. That's a pretty nice size move, so let's stay tuned. And obviously, we really want to see it hold this flattening 200-day moving average as well. Now, let's take a look at some emerging market debt. That might be the key if things do deteriorate. So one of the things to look at, obviously, are debt instruments. This is a composite of emerging market debt. This particular ETF fund here, you can see, is now trading above the 50-day moving average. So we were in a bear phase, much like we were in the TLTs. But this one, when it really fell apart as things started to deteriorate here, emerging market debt is particularly sensitive to the tapering here, as cheaper money might flow looking for a higher return, which emerging market debt offers. If this starts to fall, you definitely want to take note of that, because that could be the clue to what's going to happen in the spiders as well. So EMB is the symbol. Key component here is the level probably around a confirmation would be a move beneath 105.75 in this particular instrument. All right, so we got a pretty good overall view of the markets here. We covered the S&P. We know we're at the inflection point. Obviously, the breadth of the market in terms of the Dow and the big industrials certainly lagging. Volatility, some level of concern. We are running pretty rich in terms of market internals. Gold and silver and metals certainly outperforming overall this year, which is also an interesting sign. So we definitely have got some warning signs on the horizon, but things can easily change, and the price action in the S&P, certainly if we can power out through those new highs, would probably negate all that, and you might actually be entering into a parabolic move, because if we have short covering by some of these large players, that can definitely fuel a large rise. Now, on the other hand, at the inflection point we're at, is a potential sell-off could be substantial, as there are definite overtones to that as well. Thanks. Hope you enjoyed this. See you next week, and good luck trading.